Two of the cheapest investment platforms are Vanguard and IWeb, but they charge you fees in completely different ways, which makes comparing one with the other slightly difficult. So in this video, I'm going to focus on how you do that comparison. It actually depends upon your behavior, which is going to be cheapest. So let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start by defining what we mean by a platform. Its first function is to let you buy and sell assets. That could be shares, bonds, or funds. Once you've bought them, a platform will hold these assets securely. And if you want to check their value, you can do that via the web or via an app. Some platforms also offer research. For example, Hargreaves Lansdown offers a Wealth 150 list, or it could just be reviews of different investment funds. But you should be cautious because some of this research is in fact just marketing, and its purpose may be to try and get you to buy and sell more assets, because this increases the revenue of the platform. There are several of these platforms available on the UK market. The largest is Hargreaves Lansdown. But here we'll just look at two of the cheapest, Vanguard and IWeb. And it's not just about the cost. There are other aspects to choosing a platform, and I deal with that in detail in my course on finding the right investment platform. The first fee to consider is the account fee, but this goes under many other names, such as ongoing fee, platform fee, or custody charge. In the case of Vanguard, it's simply a percentage of the amount you invest, charged to you each year. So say you invest £10,000 with Vanguard. Every year you'd pay 0.15% of that £10,000, which is £15 per year. IWeb is very inexpensive because its platform fee is £0 per year. So on the face of it, you might consider that IWeb would always be cheaper than Vanguard, but as we'll see, that's not quite true. Because Vanguard's fee is a percentage of the amount invested, as that amount increases, the amount you pay also increases. But that increase isn't indefinite. Once you reach £250,000 invested, Vanguard caps the fee at £375. You'll never pay more than that each year. But some of the account fees are charged completely differently, as a fixed cash amount each year. So for example, Interactive Investor charges you £90 per year, which means if the amount invested is £60,000, that would exactly equal the Vanguard fee. And in turn, if you invest more than £60,000, that means that IWeb's annual fee would be cheaper than Vanguard's. Alliance Trust charges you £120 per year, which means the account fee would be cheaper than Vanguard if you invest £80,000 or more. In addition to the ongoing fee, some platforms charge you an entry fee and an exit fee, which is why I've shown this revolving door. This is where IWeb loses out to Vanguard, because they charge £25 to open an ISA, whereas Vanguard charges you nothing. And IWeb also charges you an exit fee of £25 per stock, but that's capped at £125. Again, Vanguard wins on this score because it charges no exit fee. IWeb charges you for every trade that you do. If you buy UK stock, they'll charge you £5 dealing commission, and if you buy a fund, again they'll charge you £5. And for an international trade, you'll pay an additional 1.5% for the foreign currency charge. With Vanguard, you can only buy their own funds, and you can do that in one of two ways. If you're buying an exchange-traded fund, then you can choose to pay a live price, which means that during market hours between 8 o'clock and 4:30, you can pay a known price that you see on your dealing screen. Alternatively, you can wait until the next trading point, which means that you may not get exactly the price that you see on your screen right now, but you may be willing to put up with that given that you pay no trading cost. And in the analysis that follows, we'll assume with Vanguard that you've gone for the next trading point, so you're not paying any trading costs. We're now in a position to answer the question of which is cheaper. Because of the way Vanguard charges its fee, if you invest a large amount, then you'll pay more with Vanguard. So you're better off with Vanguard with small invested amounts, relative to IWeb. And because IWeb charges for your trades, Vanguard will be cheaper if you do many trades. To put some numbers behind that, let's consider what happens if you have £10,000 invested in your ISA. Vanguard's annual fee in that case would be 0.0015 or 0.15% of 10,000, which is £15 per year. In order for IWeb's fee to be £15 per year, you'd only need to do 3 trades. because each of those costs £5. And it's extremely likely that you will do about 3 trades per year. In the first year, you have to open an account and you'd have to buy some investments. And in following years, you may want to rebalance your portfolio or invest in more assets as you drip feed money into your account. How about if you invest £20,000? Well, in that case, Vanguard's fee increases to £30. And now you'd need 6 trades in order to match Vanguard's fee. So you can see that as we increase the amount invested, you'd need to trade more in an IWeb account in order to equal the amount you're paying for your Vanguard account. We can illustrate that with this graph, where I've shown time in years on the x-axis and the cumulative fee on the y-axis. The 2 lines that start at 0 are Vanguard fees, because it has no entry fee. Its entry fee is 0. Whereas for IWeb, the initial fee at time 0 is £25, which is its entry fee. I've shown the cumulative fee with Vanguard if you have 10,000 invested in blue, and if you have 20k invested with Vanguard in red. And that has twice the gradient because it has twice the annual fee. The orange line is IWeb with 5 trades per year, and the green line is IWeb with 10 trades per year. Again, the greater gradient shows that more trades means higher fees. Although Vanguard starts off cheaper, after 5 years, IWeb becomes cheaper, as long as you manage to do 5 trades per year and you have 20k invested. But notice that if you do 10 trades per year and you have 20k invested, IWeb will always be more expensive than Vanguard. So the cheaper platform depends very much on your behavior. And here I've summarized that relationship between trades per year and amount invested, with the red blocks showing where Vanguard is cheaper and the green blocks showing where IWeb is cheaper, and in parentheses I've shown how many years it would take for IWeb to catch up with Vanguard, to become cheaper. So if we have 5 trades per year and 20,000 invested, it would take 5 years for IWeb to catch up with Vanguard. Whereas if you have 20,000 invested and you have 10 trades per year, Vanguard will always be cheaper. So you can see that having large numbers of trades favours Vanguard, and having large invested amounts as we go down the table favours IWeb. So if you can control your own behaviour, perhaps you could limit the number of trades and make IWeb work for you. Or if you know you don't have much to invest, then Vanguard will always be cheaper for you until you start to grow your invested amount. I hope you found that video useful. Many of you tell us that you do find them useful, and if you want to keep them coming, then consider supporting us on Patreon. It costs you just $5 a month, which is less than a cup of coffee, probably. And if you do that, you can join us on our live Q&A session every week and ask any question you like, and join us on our Slack channel. And if you pay $10 a month or more, like Kishore Bhagwat, Robert Bradbury and Ian Stenton, then you get additional features, such as a one-to-one power hour with me every other month, or bespoke analysis of your portfolio for the return and correlation. So I hope to see you on that live Q&A session, and as always, thank you for listening.